Welcome to Alu Speaks with Alu Patience. Today we will be discussing on the topic securities. This is the first topic on Modus 4 in the course Corporate Finance. If you have not watched our previous topics, I would advise you to do so. I have realized that most of us here do not have a business-oriented background. However, do not worry. I will be breaking down to this class to be as simple as ABC. At the end of today's class, we should be able to understand what securities are and what security instruments are. We should be able to understand the various types of securities and how derivatives and hybrids changes the flavor of our securities and the uses of these hybrids and derivatives. Investors with surplus funds invest their funds with third parties or firms in need of these funds, and in exchange they enjoy dividends or interest on the funds they have provided. The investors do not provide any effort but just contribute their funds. The effort to generate revenues from this fund is on the third party, that is on the firm. This is what security is all about. Securities are funds from passive investors who are looking for profit in the form of dividend or interest from the effort of third parties or firms who they contribute these funds to. Therefore, security is a combination of funds from these various investors for the purpose of them making profit in the form of dividend or interest to be managed by a third party. And investors, they achieve this by purchasing financial instruments. And the firms or companies to whom these funds are given, they issue financial instruments or certificates to the investors to the tune of the value of money they contributed. And these financial instruments, they have the potential to create additional value above the face value written on the certificate, that is above the amount contributed by the investors. And this additional value can benefit both the issuer of the certificate, that is the firm, and the holder of the certificate, that is the investor. A security is a financial instrument that represents any of these things: a stock, a bond, a hybrid of both a stock and a bond, or a derivative gotten from a stock or a bond. I will break these things down. But let us first look at who are the issuers of financial instruments. The issuers of financial instruments include our banks, who provide loans in the open market, financial institutions, who provide investors with different forms of hybrids and derivative instruments, public corporations, who issue securities in the form of ordinary shares, and even private companies who do not trade in the financial markets. They provide high yield bonds, that is loans with high interest rates, because they have a low credit rating in the market and they cannot sell in the financial market. We also have the government, who also issue bonds in the financial market. And when I say government includes both the federal government, who issues sovereign bonds such as treasury bills. Even the state and local government also issue bonds to fund their infrastructural developments. Federal government parastatals and institutions also issue securities, pending when revenue they are expecting from the federal government arrives or their earnings improve. Mortgage banks and other financial institutions also issue bonds to cover loans for houses, mortgage loans, and car loans and whatnot. The reason why all these parties issue financial instruments is to generate funds for their capital investment needs by attracting people who wish to invest in these securities for an exchange of dividend or interest. A financial instrument can either be a stock or a bond, or an hybrid of a stock and a bond, or a derivative from a stock and a bond. We would obviously explain them. Let's start with the stock. We are talking about ordinary stock or common stock. It means the same thing. It is a security instrument that represents ownership in the firm. Owners of common stocks are called shareholders. And holders of common stock have some specific rights, like their right to vote on key corporate matters or at the AGM, annual general meeting. Right to receive dividend. Sadly, dividend is not usually guaranteed in this type of financial instrument. They also have preemptive rights. That is right to buy up new shares before those shares are offered to the public. They also have the right to transfer ownership or sell their shares freely, and rights to adequate information through the financial statement. And in a situation of liquidation, they have the right to residual claim on the assets of the company after debtors and preference shareholders have been paid. I know I said that they have a right to their dividends, but those dividends is not guaranteed, as debtors and preference shareholders must be paid first before the ordinary shareholders are paid. And this same scenario, it plays again if the company is being liquidated. The debtors and preferred shareholders will receive their claim first before the ordinary shareholders receive. This means that the level of risk in this financial instrument is very high. However, this type of stock is good for investors that want to grow their investments. Someone once asked me, what is the difference between shares and stocks? Share is a unit of ownership, while stock is the total numbers of shares you have in the firm. That is, share is one unit, stock is all the numbers of units you have. The beautiful thing about stock is that it appreciates more than other type of financial instruments. And the value of such financial and the value of these stocks, they move up as the financial performance of the company improves. Let's move on to bonds and debentures. These are simply long-term loans or long-term debts that are provided by investors to firms and governments with a promise to pay interest. And this interest is usually called coupon rate. What I'm saying here is that bonds are funds that carry a promise to pay back a specific amount of money with interest at a future date at maturity. It is a form of borrowing. Most bonds provided by the government are risk-free because the certainty of government paying back their loan is very, very high. However, bonds issued by corporate entities, their risk depends on the creditworthiness of the corporate entity. Risk attached to bonds issued by private corporations are higher than risk attached to bonds issued by large corporations. Debentures, on the other hand, are like bonds. They are also long-term loans, but the difference is that they are unsecured instruments. By unsecured instruments, I mean that these debentures, they are not backed up by collateral. And because they are unsecured, they have higher risk than bonds. And we know that the higher the risk, the higher the interest rates investors will demand. Investors in bonds are called bondholders. Unlike the shareholders, they do not carry voting rights, but their interest is guaranteed, and they are paid before the ordinary shareholders. And also, in the event of winding up of that company, they are also still paid first before the ordinary shareholders. Not to mention that their interest rate charged is a fixed amount. That is, the coupon rate is a fixed percentage. This does not mean that they don't suffer default risk, because there is no 100% guarantee that your creditor must pay at the right time. And they also suffer inflation risk. So we can easily see that bondholders, they are creditors, meaning that bond and debenture shows a creditor relationship between the investors and the issuers. You may ask, why do firms issue debentures? Why don't they simply go to the bank and take a loan? The reality is that bonds are preferable to bank debt. Why is this so? Bonds are issued to many investors, which means there is competition, and this competition will drive down the interest rate. But if you go to take a loan from the bank, there's no competition there. It's just between you and your banker. And therefore, your bank loan, your bank interest may tend to be higher than a bond interest. Apart from the fact that you can raise a large sum of money at once from the bond market, but bank loan is limited to the bank's capacity and regulatory restrictions. The bond market can offer a longer maturity date, as high as 10 and 30 years, but banks can only offer short and medium-term loans. Bonds are very flexible in that they can be structured in different ways to suit the investors and the firm. But bank loans are not so flexible. Bondholders do not have a right to interfere with the management of the firm. They allow the firm managerial freedom. But once banks lend money to firms, they can impose restrictions on the firm and even monitor the firms. Bonds can be traded in the financial market, but bank loans are not easily transferable. And investors prefer a financial instrument that gives them that liquidity, like bonds. Apart from the fact that issuing bonds can be a signal that that firm has a strong reputation and is also very creditworthy in the capital markets. Although it is not in all situations that bonds are better than bank loans. Bank loans are more preferable when the firm is very small and not well known. And obviously, small firms cannot access capital markets. Even not all big firms can access capital markets, except they are public firms. That is, firms who have already been registered to trade in the capital market.
Also, bank loan is a better alternative
If the firm needs funds very quickly, and also if the firm prefers
a simple financing structure.
hybrid securities. These are securities that have the characteristics of both a debt and a stock. We understand that hybrid means two pieces of two different things. So a hybrid security is a security that is both a piece of debt and a piece of stock. It has the characteristics of both a debt and an ordinary share. Why do firms create such a hybrid? Why do firms mix characteristics of debt and characteristics of ordinary shares into one security? It is to make that security more attractive and marketable to investors. We remember that the financial market is highly competitive. So we need to push products that can compete favorably if we are to acquire our needed funds. There are so many hybrid securities in the market. Some of them includes the preference share, the financial lease, the convertible securities, the participating securities, and the detachable securities. The preference share, or sometimes called the preferred stock, it is a financial instrument that is less common than the normal ordinary share. But like the ordinary share, it represents ownership in the firm, but it does not come with voting rights like ordinary shares. The preference shareholders, they are paid a fixed dividend, a percentage, unlike the ordinary shareholders who are paid according to earnings. The preference shareholders, they are paid their dividends before ordinary shareholders. They have priority before ordinary shareholders to receive their dividend first. That is why they are called the preferred shareholders, because they are given preferential treatment above the ordinary shareholders. And also in the event of bankruptcy, preferred shareholders are paid off first before the ordinary shareholders. So one may ask, how is it a hybrid? It is a hybrid because its dividend payment is a fixed percentage like debentures and bonds. So that fixed percentage of dividend, it gives it the characteristics of a debt. And the fact that they are owners of the firm gives it a characteristics of a stock, of an equity. Sadly, this their fixed dividend does not appreciate with market performance like the ordinary shares. So if preference shares are like debt, if they have characteristics of debt, then which is better? Should we go for debt or should we go for preference shares? Let's understand that debt is still cheaper than preference shares. Why? One of the reasons is that interest on debt, they are tax deductible. That is, they do not suffer tax. But preference dividends do not have such tax shield. And also, debt holders have priority before preference shareholders. Debt holders are paid first in case of liquidation, in case there is earnings, before preference shareholders. Let's not forget that interest on debt, they are fixed and they are legally binding. But fixed dividend on preference shares can be delayed if there is no profit. Also, debt do not suffer any ownership risk that a preference shareholders suffer. Not to mention that debt has lesser risk than preference shares. Finance lease is another hybrid security. Before we discuss on the finance lease, let us first understand what is lease itself. Lease is the process of obtaining the use of a fixed asset, a tangible physical asset, at a lower cost for a certain period of time from the owner of the asset. The owner of the asset is called the lessor, and while the person or the firm who receives the leased asset is called the lessee. The reason why firms participate in lease is mostly because full payment for that asset will take a lot out of their cash flow. That is assuming they won't have the funds to purchase the asset outright. And if they decide to even take a loan to purchase the assets, the interest charges on that loan may be very heavy on them. So they decide on a lease where they simply pay a periodic lease payment for the use of that asset. There are two types of lease. We have the operating lease and the financial lease. The operating lease is a lease that can be cancelled. In this type of lease, the total cost of the lease is usually less than the cost of the assets. This is very common in Nigeria in public transportation, where the owner of the bus or tricycle gives out that vehicle as a lease for monthly or periodic lease rental. The financial lease, on the other hand, which is what we are more concerned about here, is also called a capital lease. It is a lease that cannot be cancelled, as it's a long-term lease that may cover the economic life expectancy of that asset. The total cost of this type of lease is usually greater than the cost of the asset, because the lessee will use that asset to the bone, and at the end of the terms of the lease, the lessee will own the assets. That is, ownership right is now transferred from the lessor to the lessee. However, most lease contracts usually contain the option for the lessee to purchase the asset at a bargain price and at a fair market value at the end of life of such an asset. So how is financial lease a hybrid security? It is a hybrid security because it combines the features of both a debt and an equity. We say it has the features of a debt because it has fixed regular payments that is similar to interest on loan paid by the lessee. And like debt, it is also a long-term source of finance. And failure to pay may lead to default, just like debt. We also claim it has features of equity because the lessee controls and uses the assets and suffers the risks and reward associated with that asset. And this type of lease also gives the lessee the option of ownership of that asset at the end of the lease at a bargain price. So apart from the benefit of lower initial cash outflow, leaser payment itself is tax deductible. Therefore, it lowers our cost of financing. A finance lease is an intangible asset because it gives us a right to use that asset. And since such rights has an expiration date, it means such rights can depreciate, even if the asset is a land, because we are not depreciating the land itself, but the right to use the land. So it is more like amortization because we are talking about intangible asset here. And the beautiful thing about amortization is that amortization, it reduces our taxable income. And this is a cost-saving benefit for the lessee. Another hybrid security is the participating bond. The participating bond is obviously a debt because, as the name implies, it is a bond. So fixed interest rates are payable on it. However, it also has a right to participate in extra profits of the firm. That is, if the company achieve a certain financial milestone, that is, if the firm achieve a certain level of revenue and beyond, the participating bondholders have the right to participate in that extra revenue. This type of bond is usually issued by private firms or startup companies by offering a percentage of profits
if earnings exceed a specific threshold.
Why do they do this? This is because they do not want to dilute their existing shares by offering other types of bonds like the convertible bonds.
Let's continue this topic on securities in our next class.